Now, once I open up a position, I do leave it alone, and a few things can happen. Now, number one, the first scenario is the put option expires out of the money, or OTM. In this scenario, the stock price remains above the strike price of the put option until the option's expiration date. The put option expires worthless, meaning you get to keep the premium you received when you sold the put. And yes, whenever you sell a put option, that cash is available in your account immediately. You can then proceed to sell another put option for the next expiration cycle to continue generating income. Now, scenario two, the put option expires in the money, or ITM, and you are assigned the stock. In this case, the stock price has dropped below the put option strike price, and you're obligated to buy the stock at the strike price. You will need to use the cash you set aside, which is called collateral, to purchase the stock at the agreed upon strike price. This is why if you have a small portfolio, you want to trade stocks that are below $40 per share. Now, scenario three, holding the stock after being assigned. After being assigned the stock, you become the owner of the shares. Those are going to be 100 shares for each contract that you sell. At this point, you can proceed to the next phase of the wheel strategy, which is selling covered calls against the stock. If the stock is called away, for example, the call option is exercised by the buyer, you will sell the stock at the strike price that you choose. This is where things get really interesting. So say you sell a $100 put and you get assigned. Now, that Monday, the stock is actually at $101. Well, what you can do is you've already made $1. Now you can sell some covered calls on this position and make more money. If the call option expires worthless or out of the money, OTM, you retain ownership of the stock and you can continue selling covered calls over and over again. And if you don't even get exercise on the put that you sold, then you can just keep doing cash secured puts over and over and generating income. Whenever I sell puts, I actually do it on margin. But first, you need to get educated and consistent before you use margin, because that could be really risky if you don't know what you're doing. So let's talk about scenario number four. The strike price continues to decline after assignment. Now, this is pretty dangerous, and this can happen, especially in a bear market. You may incur a paper loss on the position. However, you can continue to sell covered calls, which can help mitigate losses and potentially earn you additional income. Now, if the stock does rebound, you can consider selling the stock or just repeating the wheel strategy by selling cash secured puts at a lower strike price. Now, the fifth and last scenario, the stock price rebounds after assignment. Now, this is just awesome, okay? Whenever you get assigned and the stock ends up going up and rebounding, that's the best situation that you can be in. In fact, that's the situation where you can laugh all the way to the bank. Ha 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 ha. All right, so as you can tell, you want to closely study these scenarios. You truly don't need to run any other strategy, as the wheel is a dynamic strategy that utilizes selling puts to get into the stock and covered calls to get out. Wheeling stocks will provide you steady income. Cheap stocks are also great because you can deploy a small amount of capital and diversify easily. The win rate on the wheel strategy is almost 100%. If you pick the right companies, at the very worst, you have to give the stock time to recover and you will always be up with this strategy. I'm successfully wheeling Palantir, as you can see, up $269 on the stock and $116 on the options. Now look, notice how my average cost is $15 per share. That's because I got assigned when I sold a 15 put option, and now I am wheeling $16 call options. Simple and profitable. Here on Amazon, despite my option being down $369, my covered call position is still up over $1,800. I have clear rules against exiting a losing trade. I want to make profits on all of my sell puts, covered calls that compose the wheel strategy. Now, of course, that's easier said than done, but if you do this properly, you will have a lot more gains than losses.
I have a student who's making $6,500 per month for 8 months in a row with a $305,000 portfolio. He's only selling puts and covered calls. Absolutely nothing else. We call him a one-trick pony, but there's nothing wrong with just sticking to the bread and butter basics and keeping it very simple. My bread and butter basics is selling puts and selling covered calls. Your retirement goal should be to be debt-free and own your own home outright before you retire, so that way you can enjoy a stress-free retirement without having monthly mortgage payments, or with option income that is 3 times your mortgage payment. When I'm selling these put options because I believe in the long-term value of the underlying stock that I'm selling put options on, I am willing to acquire those shares at a lower price if the market falls, and it is not a concern to me. By selling these put options, I'm generating income upfront while only taking on the obligation to buy the stock at a price that I find attractive. So if I sell a $100 put, I can only buy the stock at $100 and I get paid for that. Whenever I open up an option position, in the meantime, I wait it out and I do almost nothing, focusing on work outside of trading, like coaching in my program. Selling put options allows me to profit from time decay and market stability, giving me an edge in various market conditions. Even when the market is not stable, I have the ability to benefit because I sell out of the money options with roughly 20 delta. Of course, it depends on the stock because for a volatile stock like Tesla, it can be wise to go way below 20. For a dividend stock, you can go a lot higher. You can even pick a delta of around 50. And that's because a dividend stock doesn't have that much volatility. So you really want to squeeze out as much juice from that lemon as possible, whereas a volatile stock, it moves up and down a lot. And for that reason, you want to go lower delta because in the case that it goes up a lot, you want to have capital appreciation. You really want to have a big return on your money. However, if it goes down, since it has so much implied volatility, since the stock is pretty crazy, even a 20 delta option still has a lot of premium to it. These two strategies align with my risk tolerance because I've carefully chosen strike prices and expiration dates that suit my investment goals. And you should carefully get into each and every single position that you choose. I typically like to go 1 week to 4 weeks, but I'm also not opposed to going 6 to 8 weeks or even 3 months out if you're a busy professional. If you get into a position properly, you won't have to do much, if anything at all, to manage the position. And that's one of the biggest secrets that I have. A lot of people ask me, Henry, how do I take profits? How do I manage a position? How do I close a position? Well, the research shows, and from my experience, when I hold an option position all the way until expiration, not only do I have to do a lot less work, but I also usually get the biggest raw return. What I mean is, I get the biggest return possible. What I mean by raw is I'm not accounting for volatility. Now, of course, holding an option position until expiration could give you some more volatility. And in many cases, my students and clients are deciding to close a position if it's down 50% or if it's up 50%. If it's down 25% in some cases, I have students that are closing that position. That is really good for risk management. But something that's good for risk management doesn't necessarily mean that you get the biggest return. For me, I'd rather practice safe risk management by having 10 to 15 positions in my portfolio, but whenever I open up a position, I do leave it alone because I wanted to make the maximum amount of money when I sell both puts and covered calls. You guys can always comment below, but I'm serious. Common comments is how do you get out and how do you close for a profit? You don't have to close to sell a put position because there's really only two things that can happen, okay? The first thing is if the stock goes below your put price, okay? Here's your put strike price. If it goes below, you don't have to actually start panicking because if you like this stock to begin with and you should only sell puts when you like the stock, then the worst that can happen is you have to buy 100 shares of that stock. That's totally okay because as we're talking about covered calls, as soon as you have this stock, as soon as you own it, you can go ahead and start generating money from this stock as well. Now, one of the biggest things is when this strike price, if the stock goes way below, can you still sell covered calls? Well, that's an iffy one, okay? If it goes really far down, in some cases, you might just want to wait. You want to wait for that stock to recover. And again, you like this stock, right? You think it's going to recover. It's a good, high quality company. So in most cases, it will recover. Now, if it just goes down a little bit, then that's the perfect scenario. In fact, sometimes on Fridays, I might get put a stock, say at $100, because it goes down to 99 on Friday. But on Monday morning, it's back to $101. And that is one of the best positions to be in when you sell a put option, you get assigned, and then that Monday of market open, that stock is going back up. In those cases, maybe I would just leave it alone. I would let the momentum ride back higher. And at some point, you do have to decide, I want to sell some covered calls and make some income on the stock that I have. I view selling puts as a way to take advantage of the market's overreactions or fear-driven price drops, potentially leading to substantial gains. But even 3% per month, that's fantastic. That's going to compound over time. And if you look at some of the best investors, Warren Buffett, they're only getting 20% returns per year or even less in some cases. So if I'm able to make 3% per month, sticking to my bread and butter basics, covered call, sell put, I'm a very happy camper because that's going to compound. And of course, you should have other sources of income that you're putting back into your portfolio. Now, choosing underlying assets or stocks with strong fundamentals and a history of stability, now that's also a really good tactic. This reduces the chances of a significant loss. And also, just again, picking stocks that you like, even if they do have a significant loss, you should never be in a position where you're really worried, because in most cases, the stock market does come back and recover. Covered calls are very similar in terms of profitability to selling put options. In fact, they are basically cousins, and I dare you, you can see right here that it actually looks the same to have a covered call versus a sell put. They have the same risk profile. Any stock that you own 100 shares of, you can now generate income using covered calls. Call option sellers benefit as time passes and the option decays in value. And this way, the seller basically makes money every single day as the option is open. That's why selling options makes money. Every single day that it decays, you're earning more money, because if you were to buy it back, you would have a gain on your hands. One big confusion is when you do a covered call, you may see your call option in the red. Now, I've seen this many times for myself, for my students. This is not a concern, and you should not panic, because as the stock rises, the short call will look like it's losing a lot of money. And in theory, it is if you were to buy it back. But if you're not going to buy it back and you're just going to let your stock sell off, then that red amount doesn't really matter. But the stock is also growing, and that's why you also have a lot of protection. So even if this covered call option seems to be losing $1,000, your stock is probably up way more than $1,000, maybe $1,200 or $1,300. So they more than compensate for themselves. So you don't have to worry about seeing red when you're doing covered calls at all. Selling call options is a fantastic exit strategy, and that's actually one of the biggest things that I use covered calls for. I want to decide when I want to exit a stock. I sell calls not only to generate income, but get out of a stock at a much higher predetermined price by using call options. Selling call options brings in premium, and I get to control the price that I want to sell the stock at. So at the very worst, I just lose my shares at a higher price that I picked. Again, everything is a very controlled environment when I'm trading options. Too many people, there's many myths out there that options are super risky. They are very risky if you're an option buyer, but if you're sticking to option selling, that's where you can see passive income, that's where you can see consistent results. And again, maybe you're not gonna make $1 million overnight, but I'm going for those stable long-term results that lead to retirement. And even with a portfolio of $305,000, that's where you can start generating significant amounts of money. Now, I wouldn't quit your job, because again, I'm not a financial advisor. You just never know what's gonna happen in the market. Nobody can predict it. But with $305,000, you can see some really crazy returns. And from there, as you build up, it's only getting safer and safer to the point where you're able to retire and focus on this full time. And when I say full time, I just mean a couple hours a week. When an investor sells a covered call, they're essentially agreeing to sell their shares of a stock at a predetermined price known as a strike price. So when you pick a strike price, it's really important to pick a strike price that you're happy with losing those shares. So say that your average cost is $98.64. Well, if you sell a covered call at $105, you should be happy to basically get rid of that stock at $105, okay? If the stock price rises above that level before the option expires, that's fine as well. You're usually not going to get assigned until the very last day. If the stock price does not rise above the strike price before the option expires, well, the investor keeps the premium. You get to keep the premium anyways, but you get to keep the premium and you get to keep doing this covered call strategy. Now, if it's above, you're gonna lose the shares, you're gonna get assigned on Friday. If you don't wanna lose the shares, what you should do is you should buy back that covered call on Friday, on the last day, okay? You wanna wait until the very last moment, because that way, theta, or the time value of the option, has decayed to the point where it's not really significant anymore. So if you were to buy back, you're only going to lose the amount of money that the option is likely in the money. So for example, say that you sold a $100 covered call and it's now at $105. well, that option is probably going to be worth about $5 on that Friday. Now, one of my best strategies is I can buy back that option, which is called rolling, and then opening up a new option. If you want to learn how to roll, this is literally one of my best secrets and one of my best strategies of all. Rolling is so important because what you can do is if a position is losing money, say for a put option, okay, if it's at $100, you can roll it from 100 down to 95. Okay, now for a covered call, let's say, again, it's at 100 or 105, okay, 105. If it's at 105, you don't want to lose it at 105, and the stock is at 106, you can move from 105 to 110, okay? Rolling is one of the best things to adjust and correct the position. If you're losing money, you can lose a lot less money. And if you're making money, you can also magnify those returns and make more money. Rolling is the best strategy, and if you want to learn rolling, this is the video that you have to watch right now.